My name is David Ellis. I'm the marketing manager of Jamaica Stock Exchange. And we are very happy to see so many persons that have turned up. You said that you're the pro, so for real, they find out if you're a pro. All right, how to buy and sell shares of pros. And we have here Mr. Jonathan Courie, the General Manager of Stocks and Security. I'm limited to bring you through that process. And I want you to put your hands together for him because Stocks and Security is one of those companies. They don't take a lot for persons to invest in the market. Isn't that right, sir? Mr. Zachary?
Yes, sir.
What's the beginning for the Stocks and Security?
Never read some document.
1 John 50.
No, son.
To actually increase it probably from 2,000 get better administratively and also to be able to focus more on
All right. So he's soon be telling you all about that. So, ladies and gentlemen, we have Stocks and Security in the room, well represented. We have Mr. Zachary Hardin here. He's the group CEO, right?
No.
Yes. And Mr. Crosskrill. Hugh Crosskrill, right? Foundation member of Stocks and Security, right? And
Allison Hemmings.
oh my God.
That's all right.
Group CFO.
I'm fairly new to the company, so that's fine. Allison Hemmings.
All right, so let's stand that everybody can see.
But,
All right, can you put your hands together for the Stocks and Security team? Wonderful, I started to like the vibes already. All right, so Courie, so with you.
Thank you, David. Good morning.
Morning, sir.
All right, so a little bit about myself. I've been working with Stocks and Security Limited for about 6 years now. I moved back in 2013. I lived about 11 years in Canada before. Prior to joining, I worked at the Royal Bank of Canada downtown for about 3 years.
Sorry, sir, Courie, just speak up. A lot of people outside here too.
All right, yeah, thank you. All right, so prior to Stocks and Securities Limited, I worked at the Royal Bank of Canada downtown for about 3 years. I lived a total of about 11 years in Canada before coming back home, right? So I'm very passionate about Jamaica. I love Jamaica.
Are you a Jamaican, sir?
Yes, I'm a Jamaican. And I'm very passionate also about investing, both internationally and locally. I've been buying Apple from when it was below $30 a share. It's gone up to over 1,000 and had a 7-to-1 stock split and back up again right now. So, since in 2000, prior to 2008, prior to 2009. So I'm going to take you through, I guess, a little bit about investing versus trading, the difference there. Talk about asset allocation at a higher level in terms of the portfolio management and how the kind of field was going down. Within each asset class, equities and fixed income, and how to deploy the strategies within those asset classes. So before going into that, just a little bit about Stocks and Securities Limited. The services that we offer are brokerage and discretionary management accounts, right? So we have accounts which we manage for you for a management fee. All the trade commissions are absorbed within that model, and we charge you a management fee for that. And we take full ownership of that management, right? And then we have the brokerage arm, right, which is really self-discretionary. So we give you the power to buy and sell as you wish, right? And of course, we help guide you along that process. We provide you with information, research, and we also have like a recommended list that we've already vetted to help you in that selection process, right? Under each model, you can come in and meet with a representative and really get to know you, evaluate who you are, what your goals are, what your liquidity needs are, both in the short, medium, long term, and of course your financial objectives, time horizon, etc. To really understand about you and to pick something that is tailored to you because everyone is different. Right? Everyone has a different circumstance and is in a different stage in their investment cycle. So it's important to understand where you are and how much risk you can take, and differentiate also the willingness to bear with risk and the ability to bear risk, because there's a big difference there. Okay. So a little bit about on the discretionary side, we have managed plans on the J dollar side, starting at 150,000 Jamaican dollars, and on the US side from 2,500 going all the way up, right? So we have different products. We have safe solutions from 2,500 to around 25,000, plum plans from 25,000 up, and the difference between them is really on the both in all different products. It's fully diversified among different asset classes, and it has an asset allocation which is tailored to you, right? And the difference is really, with more money, you can diversify more. You have that ability to diversify more. You can pick single stocks and have a better design portfolio to give you that alpha, as opposed to more indexes which are more passive, which you can do at a different level. All right, so walk you through a little bit in terms of the portfolio management process. Portfolio management is very important, but there's a higher level. The higher level is really asset allocation. Everybody, is different, and therefore the asset allocation, the strategy employed should be different. But there are different groups as well too, right? So asset allocation talks to equities versus fixed income, which are really traditional investment securities. Bonds on the fixed income side, equities on the stock side, and really how do we use a combination of traditional investments to achieve your goals, right? So a little bit about investment philosophy, which I think is very important. So it's important to understand what your investment philosophy is, what a company's investment philosophy is, to see whether or not it aligns with you, right? So a little bit about the investment philosophy that we have on the equity side. We don't speculate, right? We buy the best of breed in any sector. We diversify portfolios, right, within the different sectors to provide you that diversification. We don't want to have everything in one stock, even though that one stock is really good. We want to spread it out. But on that philosophy, we don't want to speculate too much. We want to, go with stocks and investments that we know, that we believe in. For example, on the international side, Google, right? Google has a competitive advantage. And it will maintain that competitive advantage in years to come, right? There's nobody that's going to disrupt Google's market share right now and predominance and competitive advantage that they have within that market, right? So long term, Google would be a very, stock that we would believe in, and it would form one of the bases of, it would meet that check mark in terms of that investment philosophy. So it's solid. Long term, it has really good growth potential, very good management, track record over the years, and so that would form one of the investments within the equity allocation, right? Which would then roll up into your total portfolio, right? So everybody shouldn't just be in equities, right? They should have a diversification. Why? Because fixed income is for preservation of capital. Right, so we all have different stages, and we all need, as we grow, as we transition throughout the investment cycle, right? We go from, capital accumulation, capital growth stage, right? Growing the capital, to then preserving the capital later on, because that's our goal, right? Our goal is to grow the capital and generate growth while we are able to take on the risk, and then shift the gears into preserving the capital when we need to preserve that capital and transition towards income later on in life, right? So that's the goal. That's all of our goals, right? And that's, in an ideal situation, we want to really capitalize on the growth, right? On the growth factor, right? And how do we achieve growth? You can achieve, the risk tolerance is different per asset class. So, for example, you can chase bonds and try to achieve a high return on bonds, right? And those bonds will carry inherent risk in that, right? Because really and truly bonds should be preserving capital. It should not be generating a high return. And if it is generating a high return, you should ask yourself why. You know, there's obviously some risk inherent within that fund instrument, right? So again, investment philosophy is very important, and it really forms the cornerstone of your investing, right? So once you understand and once you can relate to that investment philosophy, then you can tweak the asset allocation, to your liking, right? And also deploy the investment strategies in the asset class below, right? That make up your total portfolio, right? So a little bit on, an example of how we can, I know I'm talking a lot about portfolio construction, but I think it's important, right? Security selection is within a portfolio, right? So you have fixed income, and then you have your fixed income instruments, right? That would make up your fixed income portion of your asset allocation. And then you have your equities, right? Which is supposed to deliver more growth, higher risk, higher return. So there's more volatility associated with equities as an asset class, right? There's more volatility associated with equities. But we can manage the risk within each asset class, right? So even though equity as a class, as an asset class is higher risk, higher reward, we can still pick very safe equities within that asset class, right? And similar to bonds. Bonds can be treated as safe, but you can, pick very high risk bonds and find yourself in a problem, right? So it's important to understand, I guess, risk, and your financial goals. That's the reason why we meet with you, right? To understand where you are, what your goals are, filling out a risk profiling questionnaire to really scientifically evaluate how much you can take on the risk, right? And going through an investment policy statement really helps us understand how to manage your portfolio within these parameters. And the parameters in terms of the asset allocation and the types of securities that can be deployed in each is really based on your goals, your needs, your financial constraints, your liquidity issues. So for example, if you have liquidity issues within a year, well, you should not be investing, right? Because I can't guarantee that investment will stay the same for that year, right? There's going to be volatility. The premise behind investing is really picking companies that you believe will grow over time. So if a market pulls back, in theory, if you're picking good companies, those companies will recover and recover more, and it'll even present you with an opportunity to average down, to add more to your portfolio, to add more to your securities that you believe in. So for example, it goes, again, investment philosophy. If you believe in Google, and Google goes down by 50%, will you put more in Google? Right? And you might be more inclined to do so than a speculative stock that you are just kind of going off on a will, just trying to see if this works, right? So we've heard a lot of different speculation. We've seen how the market internationally have changed over the years, and that helps us also put context on the Jamaican market. So the Jamaican market, just to shift gears a little bit to Jamaica for a second, has done phenomenal, right? Phenomenal, right? Over the last 5 years, a phenomenal growth stage, and that's off the heels. For those who don't have that have seen all the seasons, that's off the heels of 5 years of very lackluster performance, devaluation, inflation, eating at those returns. So really and truly, for those 5 years, before the return that we have right now, if this stock wasn't performing, it would be 20% really loss of real value. It would be maybe 10% maybe inflation that was annualized over that period, probably a devaluation of a similar factor, and then of course there's other risk factors as well, right? But that being said, kudos to how well it's done, and internationally and even locally, in terms of how it's been able to transform wealth, right? Now it's important that we don't have everything in equities, right? We should have some diversification, we should have some stability to a portfolio, right? And how that portfolio is constructed is really dependent on you, how much funds you have available at the time, what your goals are, and really what options you can really work with, because at every point in time is different. If I'm cash rich right now, right? And I'm going to have a duration of maybe 5 years until I need these funds, then yes, we can go about investing and we can go about taking on a little bit more risk, because you have the time horizon, you have everything kind of lined up. You don't have to draw down on these funds, but you don't want to find yourself in a situation where you're drawing down at the wrong time, right? The market has pulled back, you have needs, and you're drawing down at a time that you really should be adding to the market, right? So it's important to make sure that you know how much you can invest at any point in time. Whether, I look at it as a pond, right? So do you want to, go, put feet in the pond? Do you want to go knee deep, knee deep in the pond? Do you go waist deep, or do you go all in, right? I mean, how much do you want to be invested? It's up to you, right? And you're the best person to really understand your liquidity needs, right? But assuming that you have the time horizon, assuming that you have the liquidity and that you're able to put it aside, and this is investing, this is not trading, right? So there's a difference between trading and investing. Investing is long-term investment, right? We're believing in companies long-term, and we're looking to give it time to grow. And as the companies grow, the shares grow, portfolio grows, you grow, right? That's the premise in the long term, right? Trading is more speculative. Trading is more, how do we capitalize on the short to medium term, right? And what strategies do we employ there, Trading is based on maybe an efficient market hypothesis, which talks on all prices being efficient, which is not perfectly true, but it goes on the assumption that at any point in time, the price and all information is reflected in the stock, and there are different ways that we can trade. We can trade using technical analysis, right, which is, I guess, the most common way of trading, right? If we're gonna have a time period attached to it, then you can combine different approaches, and we'll talk about how to combine the fundamental and technical and so forth. But just finishing up on trading. Trading is speculative. Trading is short to medium term. Trading is not long term, right? A portion of your portfolio can be used to trade, but your total portfolio really should be safeguarded, secure, diversified, and given the legs to grow in the areas that you need to grow. So that when I say legs to grow, I'm talking about the equity market. That's where you really get the growth. Fixed income is really just 5% USD return, very conservative, very safe, secure, and you're just going to put it there, and you're just going to have that portion kind of protected while you look to grow your other side of the portfolio, which is equity, right? And at any point in time, back to the asset allocation, you can switch. You can tactically deviate from the asset allocation. So, rule of thumb, buy your Asian bonds, right? So if you're 50, right, you should have 50% of your portfolio in bonds and 50% in equity. That's asset allocation at its most basic. Now, of course, if you need the funds in a short-term period, then that changes a little bit, right? Or if different circumstances, your risk tolerance and, all of these things come into play, right? So, so once you find out where you want to go in terms of your objective, your risk tolerance, how you go about taking on risk within each asset class becomes very critical, right? Talk about a bit about stock selection on the equity side, portfolio creation, right? And equity management is then best done through diversification, right? And employment of different investment strategies, right? So a couple of investment strategies might be value investing, growth investing, or dividend investing. Those are a couple of strategies. And of course, there are also sectors as well. You have the technology, you have staples, which is more safe and secure. You have different sectors. So ideally, you would like diversification across all sectors, weighting in certain sectors that you believe are going to grow. So if you believe that technology right now is doing very well and has been doing well, last year up until October, Google had done 50% return in 1 year on USD, right? Apple had done 48% in 1 year, right? I mean, October marked a correction in the general market, which the general market fell by 20%, and some of these companies fell also, right? Apple fell by 45%, right? But you can actually manage that, right? So we had sold off the gains. So it's always important to I think when you weigh into different sectors, right, the sectors perform, right, and you see the performance of those sectors over time. You know, you see a 45% return in a 1-year period, you see a 50% in a 1-year period. It's prudent to just not leave it on the table, right? We only gain when we take the funds off the table, right? That's when we realize that profit. Everything is just unrealized up until that point. Right, because the market can change, that stock could go down, it could go back to where you bought it at, and you could essentially not make any money, right? So if you have a situation where you have significant gains, right, be prudent in managing those gains, right? Sell half the gains, for example. So if you've invested in Apple, and Apple has gone up by 50%, right, and Apple is a tech stock, so Apple is more risky because it's technology oriented, right, or Google, right? And it's gone up by 50%. Take that opportunity to take that off, right? And you know, if you have 10 and you've now made another 10, right? Because it's gone up 100% in whatever time frame, right? Divide up your profit in two, and maybe allocate, you know, maybe one to more risk, one to again a Google. So if you've taken off gains in Apple, maybe you want to put half of those gains to a Google and half of those gains to maybe a Johnson & Johnson. Right? Now, why you do that is because, or you might say, you know what, I want to take off these gains off and I want to put it in Johnson & Johnson, Procter & Gamble. Right? These are staples. These are more secure investments, long term, and these talk on the dividend strategy. Right? So we're talking about the different strategies. So the growth strategy is really technology-oriented stocks, or stocks that are growing at a very, you know, at a high growth rate. Year over year, they're growing at above 10%. You know, you see that track record, you know, continuing, right? Really, an aggressive growing company grows by maybe 20%, 15%, and you're willing to pay more, right? So a little bit on the difference between the growth strategies and value investing, right, and dividends. So we talked about asset allocation, about you know, fixed income and equities, right? Within each of those broad asset classes, and the ability to manage your risk tolerance within each asset class, right? But now when we drill down into maybe equities, right? And we talked about a bit about portfolio construction, and how to diversify across sectors and how to diversify across strategies, right? And also being prudent in taking gains off the table when you see significant gains on the table, right? We all want to buy a growing company at a good price, right? That's the goal, right? We all want to buy a growing company at a good price, but very often a growing company is not at a good price, right? Because everybody wants to buy that company, everybody's been buying that company, and now the stock price is so high because it's already factored in all of the positives, right? So that's the predicament that we face every day in the stock market, right? And I think we have different strategies that play different times in the market, right? So when the market is volatile, right? So for example, 2008, 2009, and we had a market pullback, a significant market pullback. Prices dropped by 45%, and this caused the recession, right? A year after, all prices recover, right? They're now where they are a year ago. So for those who sold at a 45% discount, that's just a loss right there. That's right? That's why time horizon is very important. You need to be able to keep the time within the market, and weather that volatility. Be tolerant. Be able to. If you are conservative and you're biting off more than you can chew, you're likely to make bad decisions. You're likely to sell when you shouldn't sell when things are too volatile. That's important. Why we take the time in why you should also take the time in also understanding you, what you can take on really. Differentiating willing to bear risk, because everybody's willing to bear risk, but who can really bear risk, right? So when we find ourselves in a situation where we buy good stocks. The stocks go up in price because they're growing, right? And it comes to a point in time where these stocks are very expensive. It will transition, right? There will be a transition back to more safe stocks, right? Which we're probably at that point now. So 08, 09, the market pulled back, it went back up, right? The stocks that we really believed in are the ones that would have been high conviction plays, right? The ones that you would have put more money in. So if Royal Bank of Canada goes down, or BNS goes down by 50%, and the dividend yield now is 6%, on USD, on a very well-known bank that has dividend per share increases each year for a period of 10 plus years, has a track record, has stability in terms of revenue, is very liquid from a liquidity standpoint, from all the ratios and so forth, and you know that this is a good long-term play, regardless of the noise in the market, right? So that's why it goes down to, it comes back to the investment philosophy and making sure that you're really solid in ensuring that it's aligned with your overall goal, right? But let's go back again to the market, right? The market went through a period of I guess, uncertainty in 2011, where everybody was going bankrupt, governments were going bankrupt across the world, and the gold price soared, right? So again, in periods of volatility, there's always an avenue for investment, right? So gold went up by significant percent, right? And those who are prudent in having a diversified portfolio, not only with equities, with bonds, but also with some commodities, right, would have benefited in those situations, right? So right now, for example, we have a high allocation to gold on the U.S. side, right? And that's been the case from October of last year, right? So October, and it's important to have a temperature check on stocks when they race a little bit too far, right? So from October of last year, we had stocks in significant gains. We had taken the gains off the table, right? We've been prudent in going into gold, and we did that. At the time, it was a tough decision, right? At the time, Apple, I think, was down 5%. By the time we made the final decision, it was down 8%. But then it went down to 45%, right? So it's a good example of being able to to see when a stock has gone past intrinsic value, to see when the market is running full steam ahead, to have a period of time where you evaluate performance and restructure the portfolio in taking some of the gains off the table, in hedging your risk, and then also in kind of mitigating the downside, right, by investing in commodities that are typically inversely related with volatility, right? So if you have or Carly, if you have a volatile time and the market goes down, well, gold as a hedge for the market will go up, right? Because gold, traditionally we've used gold as a value, as another way to measure money, in terms of inflation. So in terms of the strategies, right? We take time going from strategy to strategy. We have a period of time where the market is in chaos, or level and so forth. We're going to gravitate towards safer stocks. We're going to gravitate towards Johnson & Johnson's, towards more staples, towards more financials, towards more stocks that have stability, security, and presence in the long term, right? And then there's going to be a time where we get bored of those stocks, and the market gets bored of those stocks. It no longer likes a Procter & Gamble or a Johnson & Johnson because it's not delivering the return that a Google or an Apple or a Cisco or a MasterCard or a Visa would deliver, right? And we saw a change in strategy from about 2011 into in 2013 was staples, and it lasted for about 2 years, and I think growth stocks really picked up 2014-15. And it's coming to a point where growth stocks are kind of losing a little bit of steam again, and staples are becoming more, more valuable as we look at as a way to mitigate risk. So it's important. To mitigate risk, right? At all, in everything. When I'm investing, the first thing that I do is to analyze risk, right? Understand the risk that you're taking on, and try to quantify it in a way, right? Try to, you can see risk. I believe that, your trained eye can see risk. If you look at a price, on a stock price, and you see a stock price going up and down, and you see large swings in a stock price, that is a measure of volatility, that's a measure of risk, right? If compare that to a more stable increase in stock, which somehow has a higher probability of an expected return. So you have a higher probability that it's going to continue, and everything is in line, right? So manage that risk. Be conscious of that risk, and always seek to look for those stocks that have a good risk-reward ratio, right? You want to buy growing companies at a good price. So if Apple drops by 45%, should you buy Apple, right? Is that a short-term correction? Is that a long-term correction? These are questions that you would ask. It's a large drop, so is already is the price? Is it already priced in? Has the market already priced in that decline? And in most cases it has. In most cases the market does already price in exactly what's in the market, and it's forward-looking. So there are opportunities, always opportunities in which to capitalize. Right now the U.S. market is up, 45%, or Apple is up. Apple is recovered from last year, right? Google, all of these stocks have recovered from last year, right? But a little fun stuff on I think the best way to get into trading, to get into investing, is technical analysis, to be quite honest, right? It allows you to see and understand from a characteristic standpoint, price action, right? And it helps you a little bit, follow the stocks more, and get to know what's happening in the market more as well, right? Of course, that's very different to fundamental investing, all right? Fundamental investing, right? I mean, technical analysis is only really just to energize you, go out and look at some charts and feel like you're being productive, and follow the market and set your price targets. But how do we combine? How do we time the market? We don't time the market. We do not time the market, but we try to make good decisions, right? And technical analysis and fundamental analysis combined can be very powerful, right? So there are different ways in deploying strategies, right? In selecting a stock, we want to go through a different check. We want to go through a checklist. We want to make sure, one, this stock is fundamentally sound. It's growing. Its top line is growing year over year. It's continuing to grow, and it has a compounded annual growth rate of, let's say 15% per year for growth stocks. Let's say 5 to 8% per year for stable stocks, right? So you have parameters, and you say, the market says that these stocks grew at this rate, that these stocks grew at that rate, and you analyze to see, is it outperforming the market? Is it not? How are the ratios of the company? How liquid is the company? What is the debt to equity of the company? If it's above 1, that means that they have more debt than equity, which is usually a red flag. Usually, it's not always a red flag. It's usually a red flag. And why? Because some companies are asset heavy. Some companies have, like oil companies, have large, degree of assets, right? So they're going to be asset heavy. They're going to have a debt equity ratio of above 1, right? And so you have to understand industries, right? So every company is different, right? And it's just attached to a certain industry. And every industry is different, right? And if we combine all industries, we get a nice package portfolio, right? We have some technology growing companies that are growing at very high growth rates that are expensive, right? We have the staples that are more secure, stable, steady, kind of boring, but they're safe, right? We have the financials that provide the same stability in terms of dividends and provide you that kind of dividend factor, right? And then those kind of work very nicely together. Value stocks, you buy at good prices. So, for example, if a good example of a value stock would have been maybe BNS when the oil prices happened, right? I'm sure everybody remembers the oil crisis and oil plummeted, right? And BNS lost. This is in Canada, right? U.S. denominated BNS lost 50% of its value, right? The stock price went from the 60s down to 33, right? Everybody forecasted, oil and them having a large oil exposure in terms of lending to oil companies and how it might affect their book, right? And so that's a value/dividend stock. One, it meets the value criteria because something that has happened that has caused the price to go down significantly. Am I running out of time? Sure.
So, all right, 8849 FC, Grand Vitara. If you're a person who is a driver, you're blocking somebody, can you just let them out? You get a parking space. That's 8849 FC, Grand Vitara. I don't know if there's anybody inside here.
I don't know if I know my.
All right.
Thank you. Thank you. I will. All right, so back to the value/dividend example. BNS went down in price. When you have, these are opportunities, right? That you have to be following the market actively to spot, right? Understanding the risk reward as it relates to any specific security. So now we understand the market. The general market has gone down for oil. We understand that BNS has gone down by 50%. We need to take a deeper dive in BNS, right? The market says that they have a lot of loans to oil companies, and it might affect their value. It might affect their loan book or the ability to have the companies make good on those obligations. But when you look deeper, 9% of the loan book is to energy companies. The loan book is not overly material, right, to the overall operation, right, in terms of how drastic the price has dropped, right? It's already priced it in and more. And you use that to evaluate risk to say, okay, this is a drop. The price dropped by 50%. It's an over-exaggeration to the drop because really and truly, the concerns about the loan book are really not as large as it's made out to be. So it's a good investment, right, from that standpoint. And we believe that it's going to go towards intrinsic value over time, right? And those type of investments you can really make quite easily, right? Because this is not a speculative company. It has a strong track record, and it's growing, right? In terms of stability, you have no worry about your dividend, and you can treat it as a dividend play, right? So it will be a dividend investment. It will be a value investment, and of course, BNS went up to 60 again. It went back up, 100% within a very short period of time. Within that period of time, you'd have generated 6.6% on income as well. In addition to that, I mean, if the ability to and you really have to take advantage of these when they come, right? So if Google drops by 30%, you believe in Google. I'm not saying just go out and buy everything you can in Google, but that is a good indication of, I need to increase my allocation to Google. I need to purchase more, or if I didn't have it, this is a good price point to really get it, right? Okay. So again, a little bit about the strategies. I know I'm talking a lot, in terms of the information. right? So the strategies, right? Dividend, value, and growth. Diversification within sectors, so the equity portfolio. And on the fixed income side is making sure that you're safe, secure, and preserving the value, right? Before I go into relative valuation and how we go about analyzing, I guess, the local market, which is more applicable, I wanted to just open the floor for some Q&A, right? To see, I've said a lot, and maybe have some questions as to, some of the topics that I've mentioned. Yeah. Yes. So trading is again speculative, and it can be done in terms of time horizon. So with trading, it's important, just like everything, investing, trading, time horizon says everything, right? So there's a difference between a day trade and a swing trade, right? A day trade says, I'm going to speculate within a day, buy and sell within a given day. A swing trade is a little bit longer. A swing trade allows for some time, right? I think the best way to go about trading, if it is that it's just a strict trade. So trading can be treated in two ways, right? You can technically try to time a fundamentally strong stock, right, to generate a high alpha, which technically could be a trade, right? Or you could put that aside, just be trading based on technicals, right? The trading can be done just on technical analysis. So,
would you please incorporate trading into your shift toward the local market?
sure, yes,
Because
yes.
some of the factors.
So yes.
You had indicated, I give some examples of some of the stocks like does SEC
Yes, of course we can.
They offer it.
So we can trade US and
Lot of
Jamaican
companies
stocks.
out here
We can
offer
trade
it.
everything for you, right? We
You
can
can
act
give
as
it a
the
brokerage
agent
account
on
as a
brokerage
manager,
side,
when
or
you
we
can
can
manage it for you, or
manage
you
your
can do it on
portfolio
your own
for you on one
discretion.
of our discretionary management side.
that case of the cases.
Mhm. Yes.
Some time ago.
Mhm.
And
Yes.
bank out of it.
Yes. Did it before the pullback?
Yeah, no.
Good.
But I didn't know that there was any brokerage locally
Yes.
that we could do for
Absolutely.
very good.
And we actually had online trading fully for international, and it's going to be back up in about a month and so forth on the international side. And locally, we do offer online trading as well, right? So we do have straight through processing on the local side. We do. We have a very good platform. But back to the trading and incorporating the local market, okay? So the local market trades on relative valuations, very different to, I guess, the U.S. market, right? So when I hear trading, I think about technical analysis, I think about changing and moving the averages, technical indicators, and how to go about, executing that in an efficient market, which is the U.S., right? And that's really trading in that sense. Jamaica trades.
By efficient, you mean that all the publicly available information?
No.
Embedded.
No, efficient means a narrowing in the bid-ask spread. So less liquidity in a market means less efficient market. Means if I want to sell a stock and the stock is 10, well, I might not be able to sell it at 10 because it's a illiquid market. Well, it's relatively compared to a more efficient market. So I might have to sell at 9 instead of 10, right? And that's what we experience all the time in the Jamaican market, right? We see 10, we want to sell at 10, but really and truly we can only sell at 9. Yes?
Is that on the overall market or price sector by sector?
So every stock is different. Every stock has a different liquidity. But I guess overall, if you're going to compare, and this is where we're moving to that, right? JSE has done significant progress in having a new platform and all these different things that are coming, right? So we're going to get to where we need to be more efficient from a liquidity standpoint. But to your point, yes, stock by stock has different liquidity. So for example, stocks that have lower volume traded are less liquid. Stocks that have large volume traded are more liquid. And if they have large volume traded, then you can sell 10 and likely get close to 10, right? If they don't have a lot of volume, you might get 9 when you sell, because maybe the people that are willing to buy are only willing to buy 9 and they're willing to hold out. Because that's really the local market, right? The local market has to do with, and we're getting to a more efficient, where the difference between bid and ask spreads are reduced, right? Which is kind of going towards more international standards in that respect, and that's fantastic. That is where we need to be. We need the volume. We need to have more trading done. We need to have more efficient markets in narrowing that spread. But back to really the trading, right? The trading on the local market is done by PE, right? It's done by price to earnings. A lot of it is relative valuation, okay? I'm going to look at NCB and Scotia. And before I do that, let me ask you a question. What does an expensive stock mean to you? Does an expensive stock mean the price? Is $1,000 an expensive stock?
No.
Is a $5? Like, what is an expensive stock?
Slow growth. So see,
Right.
if not grow.
Right.
I compare to peer group.
Right, is really what determines how expensive a stock is, right? Because every company has different revenue. One company could be making $1 billion, one company can be making $1 million, and they could be both listed on the exchange. How do we know which one is more expensive than which? We need to bring it back to a way to analyze both, right? And we do that with ratios. That's how we standardize and value companies from one to one, right? So we have NCB at a PE of 5, and let's say another company at a PE of 10. And let's say a comparable to NCB at a PE of 10, right? Which one are you gonna buy?
105.
Why? Why NCB versus Scotia?
Because the PE is lower, the potential to grow is higher. Potential to grow is higher based on its PE.
The PE is higher?
No, the
Lower.
potential to grow
Yes.
is higher, is better because of a lower PE.
Yes.
So it's a better price.
Correct. So we're trying to find a way to make it apples to apples and compare, right? And see which one is cheaper, because the price doesn't say anything, it doesn't mean anything to me. It means nothing in terms of relative valuation, right? When we break it down and we see from a PE standpoint, one is cheaper than the other, what else do we need to do? We need to look at the revenues, right? We need to see the growth, we need to dissect the company to see, do all of these things line up? Yes, it's cheaper, but is there going to be opportunity in buying a cheaper, or is it cheaper because of bad news? Is it cheaper because they're struggling? Is it cheaper because, certain regulatory changes that might have affected their revenue? Why is it cheaper? And I think that's where, so when we look at the PE on the local market and we analyze and we see the PE, we need to know growth. And you know what? On the local market, honestly, we have progress to be made, right? We do. We're in terms of information, right? Internationally, I can get everything on a stock, and it can be standardized in a way that I can use to compare one to another, right? Yes, companies are, maybe US GAAP and IFRS, and they have different reporting standards, right? But how do we compare apples to apples across the board, right? How do we get to a point where we make everything kind of available to us in the way that we need, right? And companies have done a very good job of this, in terms of even kudos to Burrito when they had published their ongoing analysis and so forth, right? It's really the information that we need on the local market to make the decisions that we want to make, right? And the speed in which to make those decisions. Yeah. Sorry, yeah. Right. Yeah. Which part? fundamentals? News. Okay.
Can you just give him the mic so everybody can hear the question?
Yes.
All right, good morning, everybody.
Morning.
So my two questions were, how do you go about calculating your risk-to-reward ratio during like day-to-day trading? And the second one was if you use news only for fundamentals.
Thank you. Okay. So to answer the risk-reward ratio, so risk can be measured in different ways, right? Price risk can be measured with standard deviation, right? And then of course we can have a return function, and then we can see, return over standard deviation, which one provides more return per unit of risk, right? That's one way of doing it. And also you can evaluate the risk based on different, I guess experience as well too will allow you to evaluate the risk from a top line standpoint, from a capital structure standpoint, from a even a political standpoint, because a lot of things can add to risk, right? So for example, if you have a company that is that has very good ratios, but their products can be very heavily influenced by maybe government and maybe certain changes that could happen there, then there is a certain risk factor attached to that company. I think a good example maybe was I think they had like this airport in maybe El Salvador and so forth, which had different had 3 different revenue streams, and they lost one because of the government. Immediately, 30% gone revenue, right? Because of the government, because of a change made, right? So risk is I look at price risk, volatility. I think I try to base a lot of things assuming that we're trying to become efficient. The market is trying to price in all the information in the market. It's not fully efficient, but I mean that's the premise, right? We want to get to a point where it really does reflect everything, right?
I accepted my definition of efficiency, Sorry? Earlier I asked about efficiency.
Yes.
And you said it had to do with the spread between the bid and the ask price. Now you're explaining efficiency as factoring in the information that comes every day.
I think with more information, right? It will lead to an increase in trading volume, right? And with an increase in trading volume, right, you'll have more efficient markets, right? And on that premise, it would be moving towards efficiency, right? But right now we do have a large, in some cases we do have large differences in what you can buy and sell a stock, right? It could be even $3, it could be $2, it could be large differences, right? And I think efficiency is really based again on security as well too, right?
I would venture to guess that many of the traders in this room like volatility.
Well, yeah. I know, traders, yes. Which is different to investors. And you know what?
Eventually, we get to know the floors and the ceilings.
Yes.
And if it's selling at the floor, you're buying. You're waiting until it goes back up. There are a few stocks that
which is support and resistance, right? Yes, agreed.
Consecutively each time.
A trader's ideal situation is volatility when their models work. Yes. When they're and they have to be on point, right? Because you have to just know the risk. You can't be looking to trade maybe just switching from international trade like a small cap stock, like a canopy growth, without understanding that there's going to be risk in that. Right? Did everybody see the canopy growth trade last year? Is everybody aware of that trade? Moving towards legalization in Canada and so forth, and Canopy and how they're positioned internationally, and Canopy as I mean, this is one significant, like it was a significant trade where you could have made like 100%, right? In a very in a short period of time and come back up, right? But right now, the stock is where it was before you made that 100%, right? It's back to where it was, right? Because just like everything else, trading, right? It's all about it's anticipation almost, right? If we are anticipating a legalization on a certain date, we know that the market is going to be very positive leading up to that date, right? But once that date hits, who knows, right? Once that date hits, who knows? So it's important on those type of trades, and those are very high risk. You can do everything, right? Those are very high risk, high reward. That you monitor what's happening, not just of the stock, but the overall market, because the overall market, if the overall market goes down, it can send a small cap stock down more than the market, right? And so, you're right, there's opportunities. Sorry? Greed. Because it goes up, and you believe that it will continue to go up, right? And you believe that, you know what, you know everything, right?
Everything.
Right, I think that's really, I think, you're right. Let's say that again,
Quick time.
So you should,
Everything for $1. I feel like I buy more like $1. That's energy dog. It's about go.
and if you decide that you're going to ignore that plan and go, you're putting yourself into more problems, which is increasing the risk.
I think that is a really good point. Did everybody hear that point?
No.
When you're entering in a trade that you know is going to be speculative, you know is going to have high risk, there are two things that you should do, right, in mitigating the risk along the way, right? One, you should have a plan, right? You should know exactly what price you got in and what price you're going to get out, right? You need to know that, because when it reaches that price, you can't say, boy, I want another. Right? You have to be prudent.
Yeah, about
And that's very important. And I guess two stop losses. Right? Does everybody know what a stop loss is?
Yeah.
Right? We can, especially on the international market, which is very efficient. It goes back to the efficiency of markets, right? We can set a stop loss. We can say, you know what? If we went from 30 to 60, I'm okay with making 55, and I hope that, maybe it goes up, who knows, but I'm willing to take a low at 55. I'm willing to set a floor at 55. And you set that, and you mitigate that risk. So if it goes at 55 level, yeah, it triggers a market order and it sells, but at least you know that, you took the gamble. You said, I'm willing to wait, and this is my stop loss. So you're always protected with your stop loss, right? And that's one of the benefits that you can, that is available to us.
How about the general rule of buying when everybody else is selling?
Sure.
And selling when everybody else?
Sure. I mean, contrarian investing says that we should do opposite the market, right? If everybody is selling, we should be buying, and there's merit.
Not all the case.
Obviously, we can't be 100% cash at all times, right? We do need to at least have some part in the markets, right? But to your point, yeah, we can employ that when we believe in the stock.
Can you consider that a takeover bid?
Sorry?
Can you consider that a potential takeover bid? If you're buying, everybody is selling, you're basically taking over the company.
No, okay,
Yes, but you can influence somebody to sell to you.
all right. So I think there's merit to a strategy where we take note when there is large selling pressure. We understand that we take some more information to try and understand why the selling pressure is there. See whether or not this is justified from a valuation standpoint, and then we make a decision. Right? We don't want to just be buying everything somebody's selling, because we could be tapping up all the time. Right? Sorry, yeah.
That makes sense, yeah. You can't trade knife. But you know, say,
any US documentation so far? What will be the tax ramifications when we receive those US dividends, when we buy, sell those US
Yeah.
with our capital gains and all that? Come back
Absolutely. So we're not tax lawyers and we don't give tax advice. So immediately I'll separate that from that side, right? But we do allow and we do facilitate the purchase and sale of securities as an agent on U.S. transactions and local transactions too. Of course, you should be seeking tax advice, even locally, in declaring your tax and gains and income and so forth. But we don't give tax advice, right? But we do recommend everyone to go to a tax lawyer separately.
the complication.
Alright, so what I want to know is, is there a fundamental way to move from a point of seeing a stock and they're saying that the stock is worth $52,
Yes.
and knowing that the stock is not actually worth $52, it's actually worth about, let's say, $45. Is there a fundamental way to move that level of expertise? Is it through training? Is it through experience?
How do you understand whether or not the stock is, how would you price the stock? Alright, so you can price the stock with different valuation metrics, right? You can use like a discounted cash flow method or dividend discount model, right? These are available. You can look up these valuation metrics, right? And essentially make a couple of assumptions that are needed within them, right? To then get to the fundamental price of what that stock, where the intrinsic value of the stock is deemed to be. If the dividend stock is ridiculous,
They won't push it further.
Right? And there are assumptions. You have to make growth assumptions, what or the discount is.
Me not understand it.
Everything is available right now, right? You can
one
look
company
up on
is
Google, right? And just how to value a stock in a very simplistic way, right? And practice in that regard. So 100% we can determine theoretically the intrinsic value of a stock. It's not perfect. Everything is based on assumptions.
And then you have one for $1.
Right? But it's very, and that point is very valid. We should all know how to value a stock, how to do relative valuation on the local market, because that will put us ahead of the competition, essentially. That will help us grow professionally and everything else, right? I mean, of course, we're professionals and we allow, we offer the services to manage the portfolio for you, because everybody's, I do this for a living, so I have the time to manage it, right? But if I did something else, I might not have the time. If I was a doctor, I might not have the time to, I might be spending most of my time on other, helping others, or investing in myself or the business on different things, right? So it's important that, we stick to our professional, to some degree. But at the same time, we all empower ourselves for financial literacy and growth. Sorry? Okay. So,
Never do.
alright, let me just. Alright, so first of all, you need
want to be a
capital.
full-time trader.
Alright, so you need money to make money.
You have overheads,
right?
you see me?
And you have to be able to tolerate the risk and go through cycles of getting burned to be able to base your livelihood on that. And it's not easy, right? Because, when you're talking about like, a $5,000 trade, or 10, and you're down 30% in one day because I woke up and pre-market is down by 30%. What do I do? Pre-market is down 30%. I couldn't even trade in pre-market. Right? I didn't set the pre-market stop loss. Right? So what do you do? Right? How do you manage that risk now that you're down 30%? What decisions do you have to make? Do I cut out right now? You could go down further. Right? These are hard decisions when you're not adequately emotionally or financially prepared to make them. Alright? So maybe experience time and include some stock simulation models, some real sweat in some money also to feel that pain. Because if I'm looking at the model portfolio, it's not the same. It's not the same. Right? You have to feel that pain. Wake up in the morning and realize that 130 is gone. From a trading standpoint. Sorry, yeah?
45. Yesterday, it dropped to 40. And this morning, somebody went to 45. And that's changing. Somebody.
Yes.
Let's go.
Your short versus JC,
Yes.
short versus there are other small institutions out there that give you a strong training, so you feel confident in yourself to make these decisions. You understand
And your own due
the
diligence.
You start to understand when is the best time, you research on data, and you understand when to go in and how to set a plan from home or to stay along.
We refer to as spear cash. There's not a lot of that over there. What can you afford to lose now?
Totally relative.
Very good.
What I was suggesting is that you have to invest in yourself first to get to that mindset, to then start making those decisions.
There's a lot of psychology.
And I think everyone should go out and try to achieve that, regardless.
Yeah.
Right? We should all, be financially literate in terms of our own finances. Because it's important, yes, we do outsource others to manage our funds, but it's important to understand the basics and so forth in oversight there. Any other questions?
But when you
Yes.
manage funds, right?
Yes.
And like bonds and so, and then you guys like US funds, and you go to like El Salvador, which is really a country that has revolutions all the time and all that. Why you putting funds in El Salvador? I mean, I can see with Barbados and Mr. IMF payments or something.
Yeah.
It's okay, but
So we don't
El
actually do
Salvador-
individual bond recommendations. So that is a very good point, okay? So we've, over the last 5 years, 6 years, the markets have changed, and I'm sure everybody has seen that the markets change, shift. We went from an advisor-based model, right, to a more standardized model. And what that means is that, over the years, most companies right now have transitioned into some investment advisory, right? But aside from investment advisory, what happened before, maybe individual relationship advisors and so forth, right, will be, and financial advisors will be giving advice, but everybody, it wouldn't necessarily be structured in a way that it needs to be structured, right? So, for example, I'll give you a little bit of a background in terms of how we go about some of those selections, right? So right now we have an investment committee, right, which is not just myself, it has a team of individuals that really analyze and review the recommended securities on the brokerage side, right? On the discretionary side, as I mentioned to you, we do not go in individual bonds, right? We use ETFs as a diversified ways to provide that income, right? Because it provides that stability to security without using funds to generate a return, right? Really and truly, we'll for accredited investors, for those that are able to put aside, a 10,000 minimum per individual bond, which we no longer do. But let's say if they wanted us to do it on their behalf, and they said, this is exactly what we want, and we appreciate your recommendation, but we want to go here, right? Maybe 100,000 US to diversify it across 10 bond instruments is really what you need, right? To ladder a portfolio, to mitigate against interest rates, to have maturities spread out, to have ratings, and the issuers as well have some diversification across sectors, not just financials, for example. Have some diversification and really do the due diligence. It's very hard to analyze a bond credit rating to be ahead of the market internationally when we're a small firm in Jamaica. It's hard because we need to jump on the earnings calls, we need to jump on the AGMs, we need to ask questions, we need to see if there's any change, we need to evaluate in terms of the hierarchy with new bond instruments. We need to do all of this, right? And that is just, it does carry individual risks, regardless of how we look at it, right? And we've seen a transition in us, in investors, right? From the time when we used to be able to get, 50% and Eagle Merchant Bank days, and that time, right? When we had that period of significant return, that's no more, right? And that developed a culture where we chased yield, right? Where we chased the return. And we got comfortable chasing that return, right? And we saw signs of this, right? So leading up to, in 2004, 2013, 14, we knew that there was going to be an increase in interest rates. We knew that it was going to have a reduction in bond prices. We saw the flight towards, towards safe, secure, investment-grade bonds, 10 duration on 10 years and less in terms of duration. And when these bonds now became 2-3% in yield, and these are investment-grade stuff that we believe in, where do clients want to go to generate that return? They're not okay with a 3% with an investment-grade, solid, 100% solid bond. They want that 6 and 7%. Where do they get that 6 and 7%? Right? That's where the high-risk jurisdictions come into play. That is where it is. But right now on the accredited side, and let's just touch on that, because I mentioned that we don't no longer do the individual bond recommendations. We do the ETFs as a way to preserve and provide diversification. We do have a solution for that tier, for that 6-7%. And we use private bond yields, we use private transactions to be able to fulfill that. Only for accredited investors. Only for accredited investors. Why? Because private bond yields are relatively illiquid. They have a period of time where we would have to find a market if you wanted to get out of it. But granted, these you can touch and feel the security, you can feel it, you know exactly what you're getting involved in. You know who is behind that as well too, right? So it provides you with that degree of assurance in taking on that additional risk. Right? So that's a solution on that side, and that's a very good point in terms of bonds and in terms of how we shouldn't be chasing those yields on the fixed income side, when we really should be preserving the capital and using calculated risk if we want to achieve that yield.
Do we have instances of short selling? What you advise on that?
No, we don't no. So okay. The short selling is very complicated, right? And I probably would not recommend it for the average investor, right? And it's also, you have to see the market in a very different way, right, to be able to do it. What I would say on that level is, if you're betting a stock will go down, just be patient until it does. Sell, take the gain, be patient until it does, and then use that as an opportunity, if you believe in that stock, to add more to it. Right, to buy at that point, to be able to take part in the update. Any other questions? Yeah.
Morning. From your experience, when an executive change is made in a company,
yes,
how often does it affect further profits or further avenues or revenue within that company?
It depends on it could be very positive. It could offer.
Yeah, well, could you point to an example? Any? I don't know.
I don't know. That's not what you said. We have.
But yes, I mean, change is not always a bad thing. It can be a very good thing, right? And it's important that we continue to evolve as the world changes as well, right? The market changes. The market that we knew 10, 20 years ago is not the market today. Everything changes, right? Times change, and we just have to be very proactive in identifying, really good investments, good risk-reward ratios in that respect. Yes.
Do you manage your clients' index funds for the international market? So do you buy index funds?
We do. So we have our safe solution,
Index
right?
is easy to make money, but kind of complicated.
Which is a balance between different ETFs, right? So
I'm just betting
it has the market ETF, but it also has fixed income ETFs as
what
well.
are the
It is
individual
not a 100%
stocks
equity
determined?
portfolio. It is a blended portfolio, and again, it is customized based on the unique client's needs, objectives, and investment policy statements, risk profiling, everything. to see what
I'm
is
pretty
best
sure
for the
everyone
client.
does it. Okay, but something more.
But yes, it
that
is more
them are going
conservative, right? Because it is index tracking, right? But at the same time, it allows, different. It provides investors with a very safe and secure investment through the U.S. And we have gold, for example, within that hedge, right? We have, if we need to deploy cash, we have a cash ETF as well too. We have the ability to, to hedge, to come out of the market if we need to take gains if we need to. If we see the SPY or the S&P 500 running up too much, we can take some gains off the table, which we've done very prudently, right? So we took gains in October of last year when before the market really tanked. But at the time, it's a hard decision at the time, right? Because if the market is doing really well, right, it's very hard to say let's reduce allocation, let's come out of this immediately. There's more downside risk than upside based on support resistance levels. Let's take some off the table, because if it continues to go up, clients will be dissatisfied, right? Because they've kind of missed out on all of this positive stuff when we're being conservative. So it's a delicate balance that you have to strike. But I think there's a lot of opportunity, and it's better in many cases to be cautious, right? To wait, to be patient. I think there are different ones, right? So on the U.S. side, so I'll talk on the broader scheme, right? We talk about fixed income and equity, right, in terms of asset classes, right? And that represents a combination, whether it be 70% fixed income or 30% equity. We'll constitute your total portfolio, right? On the ETF side, on the fixed income side, 5.5% at best, and that's gross, right? At best, right? On the U.S. side, the U.S. has delivered 13% per year on an annualized rate for the last 8 years, right? Per year, right? It's up significantly year to date, but and also that's the general market, right? There are other stocks that have performed significantly better than that as well too.
Would you say that the U.S. stock exchange now is a little tricky?
Sure.
Because
Sure.
the presidency have the ability to just march around with a single tweet.
All right, yes,
And
I did have.
tweets that way the other day.
I did have how politics play
No,
in
no, I'm
investing.
saying the whole business of trade in U.S. stocks.
Yes.
No.
Yes.
It's maybe a little different from even a year ago.
All right, so, but first of all, on that note, the president doesn't dictate the market, the Fed does, right? So I look at the Fed, and I analyze the Fed in understanding how the market is going to play.
You say the tweets will affect stock price?
It does.
No, I said in general, right? Especially in the U.S., right? There is a segregation. Right here, politics is very well implement and enforce monetary policy. Right? Yes. No, I understand.
Even the forex market.
So, emotional dimension.
Yes. Yes. I mean, I take emotions. So I take emotions out. So in terms of politics, in terms of geopolitical risks, I think it's important to account for them. I think it's important to quantify what they could be, and then make decisions based on that. So, for example, if leading up to elections, right, we're not sure, or mid-elections, sorry, if leading up to mid-elections, we're not sure, which is what we did. We're not sure of the outcome, right? We're going to, and we see the market running full steam ahead. We're going to take gains off that market. We're going to be prudent in taking that off the table. We're going to be prudent in investing in gold and in commodities that could very well favor geopolitical risks, right? And in many cases, for some of our more aggressive clients, we even went 30% in gold. I can't do that for general clients. That's, you could get fired for having such a high allocation in gold, right? But from a risk-reward ratio, at that point in time, it was favorable. We knew that we had a prolonged period of rate increases, again by the Fed, right? What does a rate increase mean to the currency? A rate increase means that the currency is going to go up, right? If rates are coming up in the U.S., all foreign investment is going to leave all over the world and come sell their currency and buy the U.S. currency to partake in U.S. instruments with higher rates, and that's going to push up the price of the currency, right? So we know that an expansionary monetary policy dictated by the Fed, right, will lead to currency increase and inflation at the top. What that will lead is temporary increase in government GDP, and it will come back in line, right? So we know that the economy can be stimulated by these measures, right? And we know that if we have rising interest rates, right, and a rising dollar, we're going to have potentially a decline in gold price, which we had for a very long period of time. But at what point does that switch? At what point does that say, you know what, we're done the rate increases? We can't continue to raise rates at the debt level that the U.S. has. We can't continue on this level. We need to start cutting back. Yes, we know that it might have other impacts to GDP and growth of the country, but we need to start cutting back. At which case, it will have the reverse effect. If we reduce interest rates, we reduce the dollar, and we increase the price of gold. That's why gold went up, 45% from that time? Right? There is significant opportunity in capitalizing on geopolitical risk if you're able to manage it properly, and if you're able to separate the noise from the fundamental or the economic policy.
Back to local now. Why is Palace Amusement so high at 1,000?
I don't want to bash this stuff, but from a valuation standpoint, I think it's we talked about relative valuation, right?
I mean,
so if
it's on the table, right?
Like
volume, have a lot of business.
It's probably like really, they trade a lot, and in which case it'll be efficient. And if it's not,
it doesn't trade at
very large differences between what we can sell and what we can buy based on who the offers out there, right? So if we're analyzing the market and we see that one stock is overvalued to the market, logic would say we probably should sell that stock and probably reposition in something that has more value, right? But can you do that? Is another question. Right? And that's the reason why we talked about the difference between how efficient markets are internationally versus how efficient markets are here. And here we've made significant progress. We just have more to go. Yes.
Next question. I've been listening to your opinion, and I realize that in Jamaica, we're trading in stocks, right? Question that I have to ask with respect to the local market. How do you know when a stock is overvalued? Because, for example, you mentioned efficiency in terms of markets, they've been at a certain level, and even if they pull back, they tend to go for those levels again, right? So, let's take NCB for argument's sake. How do I know if NCB is overvalued? Because it has been for a price that it has never been before. Yes. So now, in that price coming back, I'm looking at when is the best time to get in, and not only the best time, what are fundamental and technical sound reasons to get into that stock, see if it can surpass that level that we have been before.
That's a very good point. So we're all witnessing right now an increased valuation across the board for Jamaican stock, right? And we've spoken about when something is of significantly, you should take the gains off the table, right? And be prudent in managing that risk. Now, of course, some stocks pay high dividends, right? So, for example, if you got Courie at a good price, you'd have a better dividend yield than maybe a current price, right? So, it depends really on one, what the purpose is for that stock. Is it dividends, growth, or value, right? if it is dividends, then what is the effective dividend yield? Not the current dividend yield with the current price, which is higher as you mentioned, but the effective dividend yield, right? And then you make decisions on whether or not to sell or buy. But how do we know? Where you track it. You plot the PE across time. You see how the PE has changed across time. You plot the index as well across time as well, the main market, if it's a main market stock. And you also have to plot the industry PE as well, right? Because every industry, as we mentioned, is different. Like a technology company internationally will be growing more. Same thing in here in a different way. I mean, we have probably, it's not as clear cut as in the US, but we can analyze financials together, for example, with the NCV. We can take out outliers, right? It's important to take out outliers, and if you need to, recalculate the industry average, right? Because the industry average could be skewed by one very high P stock, and you can say, okay, that's an anomaly. Let me move that out and see, minus outliers. This is the industry average. This is where the stock is trading. This is where the market is. This is where it's come from, right? But you know what? The stock has also done X, Y, Z in terms of increase in growth in earnings. So you know what? Maybe this stock is justified, right? So that's the thought process that I would employ in terms of understanding whether or not new prices are the new norm and how they're going to be supported. But remember, other things come into play too, right? So the capital in the economy always has to find a home for money, right? So at a high level, we look at the movement of funds across countries and across, even here, we have to see where the money is going. So internationally, if money comes out of bonds, then logically speaking, it might go into the stocks. If Europe is in shambles, if everybody else is having problems, then it probably is likely to go to the US, right? So there are ways that you can use, track the flow of money to understand where the shift is between asset classes, where the shift is between strategies as well. So that's how we know when growth companies are now transitioning towards value, or the strategy should be better. For example, if we have a high price market, we're not sure of geopolitical risks, we might want to be defensive. We might want to say, we're going to cut some of the growth companies, the technology companies that historically have done very well, but you know what, if the market pulls back, it's going to pull back way more, right? So let me take the gains off, let me be prudent, let me reduce the allocation towards sectors such as technology, let me increase the allocations to staples and dividend-based stocks, right? To preserve and to fortify the portfolio, if it is, I believe, volatility is to come.
Yeah, one other question. Sorry.
Sure.
All right. Obviously, you're doing this for a living, right? So you have all the time to do all of this analysis, right? If I come to your set of organization, not saying nothing. I ask the same question, right? So I ask the same question. Or in this case where, like, in reality now, there's a particular stock that I'm thinking, should I sell it? Should I take out the gain? Would you be able to sit me down, go into all this analysis in the consultation, tell me, all right, but that decision? Because I know professionals tend to leave you to make the decision. Like when I tell us to do it, right?
Yeah.
My experience, they give you some information, but ultimately, you have to make the decision.
It's really your decision.
Yeah, I'm not saying that.
So on the brokerage side, we definitely provide information. We provide all the tools and ability to make those decisions. We also provide the guidance there too, right? From a discretionary management standpoint, we definitely manage all of that as well too, and we know you, right? For me, I meet with everyone, right? If it is I have the time, I give the same service to everyone, right? But I don't have the time to meet everyone, right? So I have to structure things in a way that it allows to protect everyone as well, and hence why if you wanted to purchase, we give you a list of stocks maybe we think you should purchase, right? And the reasons and justifications why we think you should purchase them, and now we have standardized, right?
Stock recommendation.
For the brokerage segment,
I don't follow.
for different means, right?
Yes, sir.
And if it's like, you know, higher degree of sophistication, then we have different levels and different services that we offer as well, and we charge those.
Not want to take the issue first,
Yeah.
but your company has a program on CBN TV, and I don't think information that's given out there is particularly helpful. I think really we appreciate what you have done here this morning personally has really raised the stature of the company. In my opinion.
Thank you.
What I've been seeing has not been representative of what the company can offer. And it would be great if somehow you could tweak the content of that program to do a lot for your team.
Thank you. I'll introduce Zach Hardin, our group CEO, and also CEO of FSL Jamaica and BC.
Good morning again, ladies and gentlemen. I'm not going to let you leave here. What I'm going to be doing is just have the presentation, the presenters that's supposed to be presenting over there, present here, and then they go over there. So you won't miss anything, right? Because we're having a space constraint, as you can be aware, and I see you're very comfortable here.
Okay.
You're crying out from the ground. All right, I'm going to try to do this more here. And now the smaller, the smaller please, and let everybody fit, right?
You know, one broker is doing thing, right? Is NCP. With Go IPO, the offer and all that stuff. Everybody else is just so motivated. Everybody is so laid back. Wait, security IPO without even going in. People don't have time. You will work away center, doesn't it? You don't have time to go NCB or whatever.
Morning, everyone.
Morning.
So, the first thing I wanted to say is that I feel very, very, very proud. For two reasons. I feel proud to see the turnout that's here. So give yourself a round of applause. Obviously it takes a lot for you to take time out of your day, leave wherever you are, to come here, to try and listen, to try and interact, to try and see what is happening. And I know that this room that's here now is a room of serious. It's not people that are just, So I appreciate that, and I think you should be very proud that you represent the engine of what Jamaica is and the people that are most interested in what's happening in business. And the second reason that I'm very proud is because of John. Right? So, John is our humble, quiet genius at SSL Jamaica. Okay? You're not gonna, and I'm not directing this at anybody, right? But you're not gonna see him on Instagram posting his hand on the steering wheel with his watch, or photo his most recent car purchase, right? Somebody said shape. No, AC, cool like AC. Right? You're not gonna see John doing that because he's just very serious about his work. Right? It's not about him and trying to put his own image out there and trying to make a big show of it. So I'm very proud of him because yesterday, and I like to embarrass people, right? So yesterday John called me and he's like, I'm not going to do the thing tomorrow. And I said, why? He said, because I suck at public speaking, I don't like doing it, I don't like being in front of crowds. Right, so I said, okay, help me to understand, and he explained it. And I said, all right, fair enough. I'm never going to put you in a position that's going to make you feel awkward. I said, but even though I've only known John, 3 or 4 weeks, I said, I see something in you that I'm confident as the leader of the organization that I believe in you, and I believe that you are a star and you deserve to be in front of people to be able to share your knowledge and experience. So I spoke back to JSC and I said, no man, we really wanted to come on board, and called back John and he said, you know what, I'll do it. So I want a big round of applause for John. Because not everybody is about self-promotion. Some people are just about really being deep into their craft, and that is what John is really good at. He's really deep into his craft. Every time I talk to him, I learn something new, and his knowledge blows me away. And he's not old, right? He's a youngster compared to me. I also wanted to take the time to introduce the other star in the group, Allison Hemmings, who has recently been promoted to our Group CFO. Allison, stand up. So that's Allison. And Allison was CFO before for Stocks and Securities Limited Jamaica. John is GM for SSL Jamaica. And Allison is now at the group level with myself. So some of you would have seen in the news the other day some transitions happening at SSL. And I say by all the nods, that means everybody wants to know and understand what is happening. So I'm explaining to what's happening. I had founded a company called Hyperion Equity about 4 years ago. Spent most of my working life before in business, in government, in corporate, in marketing, but wanted to switch over on the finance and investing side because I felt like I worked for a lot of other people and I've helped a lot of other companies grow and create significant wealth for themselves and their families, and I was just a salaried employee. Right? And that didn't sit well for me because I had a very unfortunate instance a couple of years ago where as an employee I had to sit in front of other people 1 week before Christmas and fire 20 people and send them home. So a very traumatic experience, and coming out of it, I said, I never want to be on the other side of that desk with somebody telling me, Zach, thanks for your services, but we no longer need you. And it was at that point that I decided I had to understand more about owning businesses and having equity in business, so that whatever it is that I'm doing it for myself. Even if I'm one of several shareholders on a team, but I'm working for myself.
That's the plan.
And so that was a big transition for me. I'm not a finance background guy by nature, but I'm also a learner. So I'm a lifelong learner. I like to learn new stuff. So I founded a firm called Hyperion Equity. Actually went to Orlando, lived in Orlando for 4 years, understudied. A good friend of mine was a Harvard grad, big private equity guy. I worked in the deal side over there, on buy side, sell side, working with bankers, sellers, everything, to really just get my street PhD or MBA, if you will, in finance and investing. And then I decided to come back to Jamaica. So Hyperion is there, it's doing well. I was focused on more large-scale government-type transactions. And then the opportunity came, Mark and I sat and we were talking about opportunities in SSL. And I said, I'm not going to come to work for SSL unless I own a piece of SSL. We had a discussion, and it's a very long story, but the short version is my entity has acquired a stake in SSL, the group, and then I've now been appointed as group CEO of the business. During this time, Mark had also wanted to set up his own entity and pursue some other interests, and the business supported him with that. So he's now out of the business, and he's set up his own entity, and he'll be doing stuff separately from SSL. So you mentioned about the program. The program is really Mark Crosskrill's program. It's not SSL's program. So maybe you might see a Jonathan Courie program in the near future. I don't know. We'll work on it. But I just wanted to make a little bit of that distinction. Second distinction I wanted to make is that you'd have seen news about SSL VC. Right? So SSL VC was a company that was formed out of a reverse takeover, another publicly traded company called C2W Music. And it was a vehicle that was set up to invest in medium-sized companies that are coming up, right? And we wanted to look at how we could support medium-sized entities that are coming up. So I'm actually one of the owners of one of the portfolio companies, Blue Dot Insights. And that's again how the conversation started with SSL, because Mark and I were talking about SSL taking a stake in Blue Dot. So just to put it in context, the SSL group, there's a company called SSL Growth Equity, but it's going to be renamed to SSL Group. That's the parent company, right? So I've taken a stake in the parent company. The parent company has several subsidiaries, one of which is SSL Jamaica, which is now Stocks and Securities Limited Jamaica. We have SSL Wealth Cayman. We have another company in Cayman that owns Papa John's Pizza in Cayman. We are the largest shareholder in Dollar Financial with Kadeem Mears, who's a fabulous CEO. Right? And then there is SSL VC. So SSL VC is just one of about 5 or 6 portfolio companies within the group. And then SSL VC owns and invested in Blue Dot Data, Bar Central, and News. And so each of them, they got like 250 to 500,000 US dollars as a capital injection into the business, and we own controlling stakes in those entities. All of those businesses were small, young, early stage startup companies. So you know how that goes. They don't really have proper financials in place. There's no auditors, there's none of that. We can debate whether it was a good move or a bad move, but the point is VC, the publicly traded and listed entity, invested in those companies. Now when those companies were struggling to get their audits done, the audits are consolidated up into VC. The end result is the publicly traded entity, VC, took a position to voluntarily suspend trading, okay, while those audits were being carried out. Still complicated. You know the auditing will have to be going back in time and trying to sort everything out, right? Then in comes Allison Hemmings as Group CFO, who's assigned to getting all of those stuff in order. Allison goes in, works with the portfolio companies. Financial controllers were put into the portfolio companies. We had a change of auditors, and Allison has worked with them, and so each one of the portfolio companies have now, as of, August, June 2018 to 19, last financial year, now has submitted and gotten approval for clean, unqualified audits. And these are for young companies. Right? So as a result of that, VC now has the ability, and we are now submitting, or have submitted, I think, our own clean, unqualified audits. Okay? So the stock was suspended from trading for some time. First voluntary, and then you'd have seen it as mandatory. Because we've now submitted, the stock is now trading again. So we were even trying to see if we could have the JSE hold out a little bit, because we wanted to be kind of coming back to the market with some good news. And they said, listen, it's not really up to us. The shareholders have a right, once you're cleared with everything, that the stock can trade again. So you'd have also seen an article that the VC lost like 20% of its value or whatever recently. That's fairly standard for when you release your financials. The other thing to note with the financials are that even though revenues were up significantly, the costs were also up, and so the losses posted were greater this year than last year. But that shouldn't really be surprising, especially to this room, because these are mid-early stage venture companies, and it's going to take a while for that growth to happen, right? So what we actually did this year is 2 things. We actually invested more money into the portfolio companies, because in order to generate the revenues and get the growth, you have to staff up. You have to put in new technology. You have to put the right financial systems and checks and balances in place. So those costs went up. So therefore the loss would have been still significant. I think it was 45 million Jamaican dollars on 250 million of revenue, or 3.
I think it's about 332 million in terms of revenue.
approximately $332 million in revenue, right? And $45 million in losses. So we're okay with that because we're now confident that everything is in place. So if you're thinking of buying VC stock, I would say hold off a little bit, let it plummet a bit more, right? And that's my advice, that's not Jonathan's advice, right? So it may go down. Yes, exactly. But what I can tell you is Blue Dot, which is probably the shining star in the portfolio, actually posted a profit this year. Right? So I think that can deserve a round of applause. So that's our young company. Just celebrated our 5th anniversary. Larry Peart is the CEO of Blue Dot. And Blue Dot is a research and data intelligence company. I invested in Blue Dot 4 years ago when I met Larry because as somebody leading strategy and marketing for a lot of companies in Jamaica, at Red Stripe, at Wisynco, etc., I found that there was an absence of data. So if I wanted to plan a strategy or a campaign, I didn't really have the market data to guide me in terms of what to do. So I used to hire all the traditional research firms that are out there, Don Anderson, Rowena Co., etc., Hope Enterprises, and I would always do market research before I planned my campaigns. Right? So I sort of see myself as I guess it's like a social scientist. So I read crowds and I read markets, and I tell this joke to people all the time that I think that probably comes from DJing, because I was also a DJ for several years. Right? So, stay on, right? So I look at what are the needs of people out there in the marketplace and then position the products accordingly. Blue Dot has some amazing technology that nobody else has. So we're using neuroscience, for example, to be able to look at and predict people's likelihood to purchase a product or not. Blue Dot was the entity that successfully predicted the Portland by-election, right? We also recently did a big, what we call a poll of all polls with the Peter versus Peter race, right? To just understand the market. We have technology now that we can go into supermarkets and just take a few images and just be able to read all of the different products on the shelf using artificial intelligence to be able to look at what the market share is and any changes in those things. We have technology now where we can put cameras into stores and we use facial coding and facial recognition to analyze the consumer's sentiments in the store. Are they having a pleasurable experience or not? Okay, so Blue Dot is a shining star. They're profitable. Bar Central is also doing well. But we've now invested in them, so you can now anticipate that that VC stock should be moving in the right direction because we have more positive news coming out. Okay, I thought it was important to clarify that because some people don't make the distinction between SSL VC and Stocks and Securities Limited. Two different things. VC's revenue is maybe $3 million US, whereas in Stocks and Securities Limited we have over $250 million US of assets under management. Right? They're two different entities, and we might even end up renaming SSL VC, so you might have heard it here first, just to eliminate that confusion. Okay, so thank you very much for your interest, your time, your support. Thank you very much, John. I think you did an excellent job. And thanks to the JSC also for having us.
All right, ladies and gentlemen, any more questions for Sir Courie? All right, no, you have asked all the questions. Brilliant. Oh, one more.
Sometimes I decide on stuff and with minimum amount of research, I decide that I'm going to buy a stock, right? But I understand that I still need to do more research because I don't feel like I have enough information from it. But I don't know where to go to get information. And that's a challenge for local stock. What's your suggestion?
Call John.
All right, so just call John. Get this number. Don't leave. And I've heard a brilliant story today.